Today, what we're going to talk about is obviously the Fed cut interest rates, a whopping 0.25%, but so many people have reached out and they want to know, what does that mean for their mortgage? Will I be able to refinance my higher price mortgage? Some people bought at 7 and 8%. Of course, interest rates prior to the Fed cut dropped down to in the low sixes, sort of baking in a bigger anticipation, a bigger cut. But what I told you guys, and I have been saying for years, the Fed does not set mortgage rates. That's a long-term interest rate, a mortgage rate. What the Fed sets is called the overnight trading rate, and it's where banks, the rate that banks borrow money from each other. They can borrow from the Federal Reserve also, but the Fed really wants banks to trade money back and forth. And but they have no control, despite what you're hearing all over headline news as wanting the Fed to drop rates because mortgage rates will drop and people start buying houses again. But Michael Pento, do you expect that we'll see more short-term rate cuts? And what are your expectations for the long-term rates affecting the 30-year fixed rate mortgage?
Well, you're exactly right when you say the Fed doesn't directly control the long-term rates just by infusing the money markets or the overnight interbank lending rate with credit. They can do something called yield curve control, YCC. They've done it in Japan. That's direct QE or Operation Twist, where they're just like buying the heck out of the benchmark treasury bonds, keep those yields lower. They're not doing that now. They're actually doing the opposite, something called quantitative tightening, as you know. But I expect something similar to happen, which happened at the end of 2024. So the Fed cut interest rates by 100 basis points at the end of 2024, in the fall of 24 to December. And long-term borrowing costs went up by the same amount, about 100 basis points, which is not usually the case. Usually when the Fed is cutting interest rates, long-term rates tend to fall alongside the interbank lending rate, usually not as much, but in sympathy with rate cuts. And that's primarily because when the Fed is cutting interest rates, they're doing so to prevent an imminent recession. The Fed is cutting rates once again, which was well telegraphed, and the long end of the bond market kind of already anticipated that. That's why when the Fed cut 25 basis points, the long end actually went up. It didn't go down in yield. And I expect the same thing to happen because what the Fed is doing now is similar to what they were doing in 2024. They're cutting outside of a recession. They're cutting because of a weakening labor market, which is not weakening so much because there's no demand for jobs on that part of hiring firms. It's weakening because there is weakness in the number of immigrants coming into this country. The labor force is if you look at the supply of labor, the labor force is barely growing at all. So the fecundity rate of the United States is like 0.5%. And the labor force growth is growing at a similar amount. You're not having adults of working age joining the labor force to the tune of millions per year like you were in the Biden administration. So the labor force is shrinking. Powell and the rest of the merry band of money printers at the Fed, all they're saying is, we're labor market economists. Non-farm payroll reports, the average has been about 29,000 for the last 3 months. We're about to fall off a cliff in the economy. Let's start slashing interest rates. But if you look at things that actually matter, like credit spreads and financial conditions, you'll see that the economy is still doing okay. And that means you're cutting interest rates into an economy that's not in a recession, which always leads to a rise in long-term interest rates. So you will not be getting lower rates on your mortgage anytime soon. You're going to see a trend in rising long-term rates as the Fed cuts the overnight interbank lending rate.
We had talked about home prices coming down, and you had said in Naples that you were experiencing 10, 15% declines. You had said that we were really in three bubbles right now, very bubblish times: debt, real estate, and equity, the equities market. That all of these markets are showing bubblish activity, and your expectation was that home prices would continue to soften.
Yeah, you're correct. We're seeing in Naples, Florida, a drop between 10 and 15%. As anecdotally from the golf and country clubs around where I live. And home prices are up 100%. in 2 years. So it makes sense that they would give some back. Just unaffordable. If you look at the home price to income ratio, it's never been higher. Home affordability rate is just the lowest it's ever been in history, because it's not just the home price in that calculation. When you look at taxes and insurance, maintenance costs, they're through the roof as well, and they're not going down, and your mortgage rate isn't going down. So the only way you can make this, what I call frozen transaction market, to thaw off is to get home prices to stay where they are for many, many, many years and having incomes catch up, or have the home price fall as incomes slowly catch up. And that latter scenario is pretty much always the case when it comes to a massive and unprecedented bubble like we see. And you correctly point out, not only in the real estate, but you see it in the equity market, and you see it in credit. We have a massive credit bubble also in the United States. We have never seen the total non-financial debt as a percentage of GDP is now 257%. Right before the global financial crisis of 2007, it was 229%. And if you look at it in nominal terms, $33 trillion in total non-financial debt, and in 2007, and now it's almost $78 trillion in debt. So we are an over-leveraged, over-financialized, overly concentrated, asset bubble-ridden economy. And the Federal Reserve knows, they know this, that if they let the natural forces, the gravitational forces of deflation to reconcile these asset prices, it will wipe out the banking system. And that, by the way, Todd, is exactly why they exist. Powell says he does everything for the American people. If he really cared, if that was his charter, his inflation target would be 0, not 2. He wouldn't have missed his target for 54 months in a row. And he certainly wouldn't be cutting rates right now. He would say, okay, banks, I don't care if you go bankrupt. I know there'll be a recession or even a depression in this country for a while, but we have no way around it. We have to reconcile these asset prices, because if we continue to do what we're doing, we're going to have a massive case of intractable inflation like we've never before seen in this country. And that doesn't really end well. That doesn't solve anything. So you're going to eventually have to have these asset prices reconcile. It depends from which starting point. The greater these asset prices are relative to GDP and income, the worse it's going to be. So if asset prices are just a little bit above incomes and GDP, well, you have a mild recession. If they're massively, 2 or 3 times where they are historically, is exactly where we are in home prices and in the equity market, you're not talking about a mild recession. We're talking about a depression. But that's what has to happen, and you can't print your way out of that, because you'll destroy the middle class of this country, which is already clinging on by a hair.
All right, so Michael does believe that the Fed is going to continue to cut interest rates, and I think that's what a lot of the news is about right now, that in November and December we'll get more rate cuts. But what I want you to understand is that it is not connected to mortgage rates, all right? Just like Michael said, it's the long-term rate that we're really focused on. Mortgage rates really go off of the 10-year Treasury, and the 10-year Treasury rates are really, what changes the 10-year Treasury? It's really the economic data that is collected, right? The national debt, which is $37 trillion right now. It's $14 trillion higher than it was in 2020. And inflation data, jobs data. I mean, when we're looking at the whole economy at large, that really moves the Treasury yield higher or lower. And we think it's going to continue to rise, and that mortgage rates are going to continue to rise, which should continue to drive down home prices. We're seeing the market soften here in Maryland. There's no question about it. I looked at the data earlier, the trends, the days on the market going up, the slowdown in the price per square foot. We are seeing price declines. The days on market, like I said, are skyrocketing. But if you need to sell a house right now, you need to understand and look at the metrics. If you're 90 days on the market and no one is coming out, we see the buyer demand when you list that house the first or second day on the market. You're seeing all of it. We're not getting buyers looking at houses that have been on the market for 3 months and all of a sudden being like, oh yeah, well, it's been sitting on the market for 3 months. I'll give you what you want. I'm not experiencing that. And if you're a buyer looking at a house, you could tell me what you think about a house that's been sitting on the market for 90 days that hasn't had any recent price cuts. And you're looking at the market, and you're looking at the mortgage rates, and you're saying, okay, these houses were priced back in the day when we had 3% mortgage rates or less than 4% mortgage rates. We're at 6.3% today. Taxes have gone up like crazy. Insurance has gone up like crazy. So what you have to come to realization, if you're a seller and your house has been sitting on the market for 90 days, if you don't want to keep that house, you need to respond in a better way than $1,000 price cut to a bona fide offer that's coming in from a highly qualified buyer. Is the agent not doing their job in this case? What kind of conversations are you having with your I would be sitting in my seller's living room. We're going to be eyeball to eyeball, right? This is the kind of thing where if I had a client that had a house on the market for 3 months, I have a bona fide buyer, and then all of a sudden you're coming back with some horrible counteroffer, dropping the price $1,000. First of all you're doing is pissing off the buyer at the other side. I don't get emotional when it comes to representing the transaction or my client. I don't get emotional. That's what I'm here for. My buyer is going off a cliff or my seller is going off a cliff, but my job is to just say, calm. Keep things together. All right, now that you've expressed that, now let's talk. I would be sitting in the living room of my seller, and I would be saying, okay, I heard what you said, but before we send this out, let's look at the data. Let's look at the offer. Let's not come back with $1,000 price reduction. Or maybe you should take it off the market and keep it. I think that we are in a situation where we are seeing the market weaken and sellers are either delisting or getting a wake-up call and saying, you know what, I've got equity in this house. I need to cut it loose. I can't hang on to it anymore. It's like the tale of two cities. We have the sellers that are in denial and they're like, well, I'll just keep my house, but they don't really mean it as they're writing their high property tax check or their expensive insurance check, and it's sitting there vacant and their power's still on and they risk vandalism and whatever else could go wrong, a water heater flooding and doing whatever it can do, versus giving another $20,000 price cut or $25,000 price cut. Man, I'd be slashing the price and saying, I'm out of here. See you later. I don't know what a bird in hand is better than two in the bush. Isn't that what they say? So if I got a bona fide buyer right now offer me a deal, it's less than what I want, but I can still make money. I still have equity and I can close that chapter. I don't know what the next chapter is going to be, right? I may be sitting on this thing for another 6 months. How much is that going to cost me? If my taxes are $12,000 or $14,000 a year, I may own this thing next year. And I'm going to hope that I get more next year. So let's see, that's $14,000 in taxes, another $8,000 in property insurance, utility bills, cutting the grass, plowing the snow, paying my HOA fees, all these other things in the market. And I'm going, what the hell? I'm just going to cut bait. Guys, we saw the home price appreciation of the century. I mean, we have not seen in history this kind of home price appreciation in a matter of a couple of years. We would have to be absolute idiots, in my opinion, to think that this is going to happen again. I mean, Michael Pento said maybe we'll have years, maybe a decade of stagflation. People can't afford this. Hello? Do you recommend homeowners take advantage of current interest rates and refinance or wait for larger cuts? It's all about the price right now, in my opinion. And I feel that way always. If you think about any real estate strategy, it has always been buy low, sell high. I mean, that's how people make their money. It's how real estate investors do it. It's not, I mean, this new wave of pay whatever and it always will go up is just a dangerous strategy because it doesn't always go up. We know that from looking at 2008. It wasn't but 15 years ago, and the bubble is way higher than it was back then. And a lot of people argue about the fact that we'll never go through this. We have never really seen anything in our lifetime that was that significant in an economic downturn, but history's riddled with it. If we go back 200 years, 250 years, age of the U.S. almost, and we look at the history, we had a lot of breaking points that kind of kept things in check. Prices would get overextended. We'd have some type of recession, pandemic, depression, breaking point every 2 or 3 years, and it sort of kept things in an equilibrium. It wasn't until post-World War II where we started to see a big divide in assets to income ratios, the haves and the have-nots. I mean, can we go on forever without seeing some type of significant downturn? I don't think that we can, and I think that we're close to one. But when we're looking at the asset price, it's always about what you can buy it for. If you buy a stock price today and it goes down tomorrow, you didn't do very well. Now, you could say, well, Todd, I can hold on to that stock and hope that it comes back, which is true, and it may come back, but how long will it be before you can not take a loss? The loss is when you sell. So what I tell people when they're buying a house today is, look, how long are you going to stay there? Can you afford it? Now's the time to buy, particularly now, within your means, because everything is expensive and we might see higher inflation and cost of living. But now is not the time to overextend yourself. 2013, maybe you overextended yourself because we were coming after the GFC when things were rebounding, and we had a lot of rebounding to do. So a lot of people made a lot of money since then, 2013. But now you're buying at all-time highs. You're buying stocks at all-time highs. You're buying houses at all-time highs. You're paying more all-time highs for everything that you need, including your automobile that's servicing the automobile. Everything is costing more money. People are getting broke. They're becoming less, cash rich. Their money is tied up in their asset. And if asset prices drop, you can't liquidate the asset to get your money if you need to be in some cash. So if you're buying a house right now, price is the most important thing. But what I try and do is I try and put it into perspective of buying in up and down markets, because we always have the people that spend the most amount of money buying a house usually buy it before June. That's historically, if you look at non-bubble-ish years and you just look at a normal market, spring's the hot time in the market. Your competition's the hottest, your exuberance is the highest, your sellers are coming on the market. A lot of the activity, people want to buy the house before they go on vacation or before the kids graduate. Then you have graduations, college graduations, high school graduations, family vacations, back to school, holidays. So historically, the best time to sell a house or for sellers to get the most amount of money is between March and June 15th. Historically, you say, should you buy now and take advantage? I'll never tell you not to buy. If you're ready to buy, you find something that checks the boxes, go for it if you can afford to do it. But if I were buying and I had some time on my hands, I would still probably wait for a couple of months. I would still probably just check it out, get ready, get financially prepared, get educated, take my course. It's a good thing to do. It's $300. It's worth it. And then I would be ready to decide, am I going to use a buyer's agent? Because I teach you how you can do it on your own. I give you the strategies, the negotiation tactics. I explain it all. I don't recommend that you go without a good agent. I never do. And I say that in my course. But there are a lot of people, if you're going to hire a bad agent, then you may as well just save the money. And it's potential that you can save a lot of money if you represent yourself. You might have to spend a lot of money if the seller's not offering any compensation or they haven't authorized the listing brokerage to pay towards your buyer agent commission. You have to pay it all 50 states. It's all out there right now. I would probably still be hanging on for a couple of months and seeing what happens and what shakes out with this inventory. Got a long time until March and spring where we should see the spring market. Hopefully it's going to be a lot more inventory than it was this spring market because it sucked. Thanks for watching our last live streams highlight reel. And if you want to see the entire show, you can do so by clicking this video right here. Hey guys, I have just released my new Todd Simple home buying course. This course is designed for anyone wanting to know how to buy a home. It's designed to take you through the entire home buying process from start to finish. You'll learn how to represent yourself should you want to avoid paying real estate commissions, the best ways to shop for a home, how to avoid costly mistakes, what to look for when touring a home, negotiation tactics, and so much more. In this home buying course, I hold nothing back. In fact, I would go to say that no one has uncovered the home buying process like I have. I've even made a way for you to gift this course to your family and friends. Visit sacsrealty.education. The link is also pinned in the comments below. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.